Hey, Bowtie Nation, Joseph Hogue here. Thank you for being with us for another one of these Monday live streams, stock market lives every Monday, 9 a.m. Eastern, just to get you ready for the week. Looking at all the stock market news, strategies, some of the trends that you need to know about to really understand the stock market this week. So we're going to get into that. Already see some Bowtie Nation members there in the citizens. They're in the chat. Love seeing everybody here. Melanie, Deep Salmon, Cameron, thanks for being here. Appreciate that. Love this kind of face-to-face connection we can get more really than the other videos we get on the channel. So today, obviously, we're going to be talking about that market update, what happened in the markets last week, what's coming this week, and over the next month or two, and really some of the stocks I'm watching that could be affected by that. Today's topic, though, lots of talk about a new world order, right? And I think this is just a phrase that people pull out every few years just to throw around, right? Like there's going to be a whole new world order coming. I think it's actually, more likely we could see a new world disorder over this year and next. Truth is, some very disturbing news coming out of parts of the world around social unrest, really related around that inflation picture that we've been talking about. And what it means, what it means for the markets and what it means for the world, really. I do have to give credit for this one to Bowtie Citizen there. Amy McKay over on our Facebook group pointed this out, kind of started this the ball rolling on talking about this, the food situation. And so I want to thank her for that, and we're going to get started right away. I do want to invite everybody to get the Bowtie Weekly. That's our weekly newsletter. Goes out Sunday night. So before the market opens every week, really gets you started on the week with those strategies, the news, the trends, and everything I'm watching for the week. So I've left a link there in the chat. Go ahead and click through. Totally free. Just something I like to do for all you out there in the community. It's kind of what these market live streams are based on. So you'll get that earlier than everyone else. So click through and look for that. And then after we cover all that today, we'll leave some room for some Q&A. My favorite part of the live stream, just being able to connect with you out there in the nation. So I do want to get to that topic here because, everybody says I talk too much. So I want to get right into that topic and talk about that, and then stick around till later, and we will talk about, market news, trends, and strategies there. So, a lot of people think that the 2011 Arab Spring movement, right? You remember about 10 years ago, unrest, riots everywhere in the world, mostly North Africa, Middle East, over through Egypt, Tunisia, Libya, Syria, started civil wars in Libya and Syria, just all over the place. And most people think it was about social injustice, right? Or social justice. Which is kind of bullshit, right? When you think about it, okay, you don't riot, you don't overthrow your government because they won't let you use Twitter, all right? You riot and you revolt because your kids are starving to death and you can't do anything about it. Okay, you riot because you see the Sultan driving around in one of his 8 Mercedes-Benz and you just had to eat the family dog. Okay, that's why you riot, and that's what we saw in 2011, and we're starting to see it right now. Okay, I want to show you, the 2011, the food index had surged something like 20%, right? 23.6%. And what we'll be using here to measure this, something that really shocked me, this United Nations Food and Agricultural Organization index, right? The FAO Food Price Index, which really measures the price of food around the world, different food components and things like that, and how much that increases. So in 2011, in that Arab Spring movement, right, this index jumped 23.6% in a year, right? And people were pissed. Okay, anytime your food costs go up 23% in a year, and people are poor and starving to death, you're going to be a little tiffed off, right? Now that same food price index has surged 33.6% this year to March, okay, and 62% since the beginning of 2020. Okay, so just in the last couple of years, you see this huge boom. I think this one is just 2022, but 60% over the last really 2 years. And we'll come down here to the data. You can come down here to the data to see the changes here. And again, this is FAO.org, World Food Situation / Food Price Index. Just type in Google FAO Global Food Index, and you'll find it there. But you can see 2022 March, that index, the global index, hit 159.3. That is 33% higher than a year ago, this 119 in March of 2021. And then if you go back here to 2020, the beginning of 2020, about 2 years ago, it was only 98.1, right? So it's gone up 60%. Food prices have gone up 60%. And even more importantly, these cereals, okay? Because most of, I eat mostly chicken and tuna, but a lot of the world, they're eating those cereals, right? They're eating the wheat and the corn and the rice. Right. So the more important one here is in the cereals. This is really the main cost of food for most people. And it's up to 170, right, from just 96.6 in 2019. So it's up 70% just in the last few years. And that is the main staple crop for most people, right? And I don't think this is done rising yet. Okay, this has climbed so high that wheat and rice and the cereals has climbed 37% in the last year, and that's before the effect of really the Ukraine invasion, right? Ukraine and Russia amount for a large chunk of the world's supply of wheat, supply of corn, and supply of barley. Okay, upwards of 20 and 30% of global exports. And those just went through the roof over the last 2 months, right, because of the Ukraine invasion. So this is not done going up. We've already seen big movements across Latin America, across Middle East, across North Africa. Okay, they've been rioting. There's like six people have died in recent protests in Peru. So it's not just the Middle East, it's not just North Africa. The Pakistan's prime minister was kicked out of office, was forced out of office because of double-digit inflation, and there was also a rioting in Singapore, right? So this is happening. This is real, and again, I think it's only going to get worse. And of course, Amy brought it up on Facebook as more of a humanitarian issue, right? She's a good soul. She brought it up as more of as an idea of what can we do, to help these people and to help this situation. I'm bringing it to you as a market idea, right? Okay, so or at least a market warning. Okay, what do you do in this situation? If remember back in 2011, that Arab Spring movements out there in Middle East and North Africa really didn't affect the U.S. market quite as much. We were already coming back from the financial crisis. We had a lot of stimulus pumped into the economy. The economy was growing because of that. It really wasn't affected too much. This time, I think it could be different. This time, I think that unrest is going to be wider spread. It's going to be across the emerging markets, especially, and maybe even into developing markets. Certainly in maybe in Eastern Europe and so forth. So I'm still kind of researching this through to see where to invest. It's probably not going to be already in those the commodities, the fertilizer stocks. You get a lot of these fertilizer companies that are already up like 60%, 60-70% in the last couple of months. Now that worries me because it's totally tied to the Ukraine situation. So if we get any kind of a negotiated settlement or movement towards peace talks in that, then those fertilizer prices are going to come down. The commodity prices themselves are going to come down. That doesn't mean this unrest isn't coming though. Okay, the food prices have already gone up for the consumer, up that 60% over the last 2 years, the 30% over the last year. That's not going away, and that social unrest isn't going away. Okay, even if we do get some kind of a negotiated settlement in Ukraine. So what I'm looking at is something longer term, something that's going to be more durable, more lasting on that social unrest. What I can tell you, despite what a lot of analysts, a lot of pundits on TV are saying, invest in emerging markets because those are going to be the big growth drivers over the next couple of years. I can tell you that's not it. Okay, if you are investing in these emerging market stocks, those are probably going to be the ones that hit hardest on this. Okay, because that's where a lot of this social unrest is going to happen. So nearly half, if we just look at the situation here, nearly half, about 40% of the wheat and corn exports from the Ukraine go to Middle East and Africa. Okay, so that's, they're obviously going to see the biggest fallout from these higher prices and things like that. And we're already seeing a lot of the unrest and a lot of the rioting and revolts around that area. But it is metastasizing to Asia, to Latin America. It could move into Eastern Europe very easily. So I do think you need to avoid, if nothing else, avoid some of those ETFs that invest in those emerging market regions. Okay, That besides, inflation has always been the big problem for these regions, for the emerging markets. That sky high inflation rate really getting out of hand for those governments there, and that causes that social unrest and that kind of thing. So I would avoid those. There's not a whole lot of ETFs that cover those regions specifically, like the Middle East or North Africa, the MENA region. There is like the iShares MSCI Frontier and Select EM ETF. That's ticker FM. So I would definitely avoid that. But even some of the larger EM emerging market ETFs and stocks, you want to be cautious with those over the next year, over the next 2 years, until you get a little bit more clarity on this, on this topic. And I'll continue to research this. If you got any ideas for what to invest in because of this, what could benefit, go ahead and put that in the comments there. Again, I don't think it's the fertilizer stocks. I don't think it's the commodities, because those have already gone up so much. I really think the opportunity is past in those kinds of investments. Looking for what comes next, what comes next on this social unrest, that kind of thing. But I want to turn it over to our market update, see where the markets are today. Looks like they are going to open lower. We're about 20 minutes until market open. Looks like the NASDAQ futures are down slightly, down about 0.4%. S&P futures down about 1/3%, and Dow down about a 1/5%. So not much, just marginally weaker. Oil is up almost up another 1%. Gold up another 1.2%. I'd have to check, but I would think that's maybe on some dollar weakness. Obviously dollar a big factor in these commodity prices. So when the dollar weakens a little bit, then that's supportive of these because we haven't gotten any real news out of the Ukraine situation and things like that, other than just kind of status quo that would be forcing that up. But we can look at here. The 10-year bond is down marginally, down to 2.82%, up. Just almost a full percent over the last month. A crazy move, and we're going to be talking about that. We're going to be looking at that very soon. I do want to so look at the markets, what the markets did, and kind of get you ready for the week here. Just kind of scrolling up through my notes. So more than half of last week's losses were due to Thursday's sell-off. Okay, Thursday Nasdaq was down 2% on one day alone, and only 2.6% for the week. So I don't think last week's sell-off was quite as bad as it looks. It was really, I think, people going into that 3-day weekend saying, what, a lot can happen over the weekend, 3 days. I don't want to be long. I don't want to have a long position in stocks. So I'm selling on Thursdays. That was that 2.1% drop in the NASDAQ on Thursday. Given that, I wouldn't say, last week was quite as negative as it did appear. Earnings reports are coming out, came out last week for the major banks, told us a lot about the consumers, and we're going to talk about that, what those bank earnings said about the consumers. It's still very supportive of economic growth, like a strengthening consumer credit. Consumer spending was still very strong in a lot of those, specifically the bank earnings from JP Morgan showed deposits are continue to rise, so people still have money to deposit into the bank. So obviously that's supportive of consumer spending. Credit card spending was up. So still very much a growing economy. It was really, though, the continued jump in interest rates, that really led to that sell-off. Okay. And what I think here is really interesting. Okay. We just looked at the 10-year treasury rate is right now at about 2.82%. Okay. It's gone up, almost a full percent this year, probably about more than 0.5% over just in the last month, which is unheard of for interest rates to go up that far, that fast. Goldman Sachs has an end-of-year estimate of just 2.7%, and most economists in a survey by Wall Street Journal are saying right around 2.5% for the end of year for the 10-year Treasury. So it's already over that point, right? 2.82% right now. What I'm thinking is that most of the increase that we're looking at on the 10-year Treasury rate and on interest rates, on those long-term interest rates, is already baked into the into the rate. So what we could see is kind of a slowing or a decreasing speed of increases, right, on interest rates from here. Now that has nothing to do with the Fed. The Fed is still going to raise its interest rate, its federal funds rate, the rate that's charged by banks, right? So that short-term interest rate by the Fed is still going to go up, but the market kind of forecasts where longer-term rates should be. Okay, forecasts off of that rate, forecasts off of economic growth, off of inflation, things like that, and the market really kind of manages the longer-term interest rates on its own, and it's driven that up 2.8%. So I do think that's going to moderate. The increase in that's going to moderate. We won't hit 3.5% at the most by the year end. So if we've only got 0.2% left to go by the year end, then that means that interest rate isn't gonna fly higher quite as much as it has been over the last couple of months. Now, why is that important? That's important because it's been the main factor in the stock market sell-off. Okay, especially the growth stocks, those tech stocks in the Nasdaq. As that interest rate goes higher, the present value of those stocks comes down. It goes lower, right? Because most of the cash flows are in the future for that, right? Something we talked about in the past on the channel here, that idea of the discounted cash flows. You discount them by these higher rates and they become, the present value is less for those stocks. Okay, so as that interest rate starts growing slower, or maybe even comes down a little bit, maybe even moderates. Like we said, Goldman Sachs 10-year Treasury end of year forecast is for 2.7%. That is, well below. That is more than 10 basis points below what the current price is right now. The current yield on that Treasury note. So if it does start coming down, that's going to be supportive of stocks. So we want to watch that. We want to be watching for that. What to watch this week? Well, let's look at the sectors right now. So here we are again on the sectorspider.com, right? One of my favorite resources. All that the sector tracker tool here, and we can go to 5 days. So see what happened last week. S&P was down 2.4% over the last week, but what's really interesting here was the ones the sectors that did well. Okay, so here's the 11 sectors of the economy, the stocks in each sector in the S&P 500 in each, how they did. And of course, energy was up last week because of the big jump in oil prices, right? Oil prices were up something like 7% last week to back over to $100 a barrel. So obviously, energy did well. Consumer staples did well just because of a flight to safety, right? As stocks sell off, then investors kind of flee to those safer sectors, the stocks in consumer staples, the stocks in utilities, things like that, where they know, they have products that people have to buy, so they have more stable cash flows. So that's why consumer staples did well. What was really interesting here was the material stocks. Stocks in the material sector, the second best return last week. And this is a cyclical sector. Okay, what that means is the stocks in this sector, you've got stocks like chemical companies, you've got building materials, things like that. They tend to follow the economy, okay? Because obviously, if the economy is growing, you're going to buy more, and you're going to need more industrial chemicals. You're going to need more building materials, more aggregates, more steel, packaging, that kind of thing. So it generally doesn't do well when the rest of the market is falling. In a bear market. But it did very well last week. And I think this is really telling. I think a lot of these companies in the sector have been surprising higher on their earnings. Just anecdotal evidence over the weekend. Talked to my cousin. He works he's in the finance department of a large building materials company, right? And he's actually said that they've started to lower prices. They're seeing a lot of the inflation they saw in that industry over the last year because of COVID, because of the lockdowns. They're starting to see that come off. Okay, so they're actually now able to lower prices, whereas they were raising them last year. So I think what we're seeing in this material sector, in the building materials, in the chemicals, in the packaging, and even the steel, some of those steel producers in that sector, what we're seeing now is the beginnings of a kind of a moderation in that inflation rate. Okay, in some of the inflation that we've seen over the last year, all the economists, the Fed said that it was going to be temporary. It turned out not to be temporary, but I think the Fed was just early on that call for some of that stuff, right? Because we are starting to see some of the supply situation that we saw last year that led to higher inflation. Some of the the supply situation, some of the other stuff that led to that higher inflation last year, we are starting to see that come off, and we are starting to see a little less pricing pressure on some of these companies. So I think that's why materials did really well. And I think, that's what you can look to over the next couple of months. Okay, there is some talk, some evidence that inflation did peak last month at that 8.5% on the CPI, on the consumer price index, and that there could be a lower reading next month. That would be a huge welcome surprise for the market to actually start seeing the inflation come down, right? It has been just barreling higher month over month, every month for the whole year. So to see that even marginally come down a little bit would be a very strong surprise for the market. I don't think it's priced into stocks yet, so I would be watching for that. The consumer price index again comes out on the 12th of every month, or the week of the 12th. So we still have about a month until that comes out. So I would be watching for that and watching some of these hardest hit sectors. We can zoom out here to the year on these sectors to see who's really been, well, that's 1 year, to this year to see who's really been hit the hardest. And you see, obviously, tech stocks, technology down almost 16%, consumer discretionary down almost 13%, communication services, and obviously this is different. In this sector, it's a lot of telecom, but it's also a lot of internet, a lot of e-commerce names, that kind of thing. So really, it's the e-commerce and the internet names that have fallen the hardest. And those are down more than 14% so far this year. So if that inflation rate does come down, I don't think, obviously I don't think it's coming down to the 2 or 3% long-term, what the market expects. But I do think it does start to come down here and starting in this next month, starts to moderate just a little bit, maybe even down to 7.5%. If we do start seeing that, I think the market's going to welcome that and send a relief rally our way on some of these stocks. But that's still probably about a month away on that. Now, I do want to talk about, kind of some of the stuff that we're watching this week, and then the stocks that I'm watching. We do get important data on housing starts and permits or existing home sales on Tuesday. Really going to be important to see, how those higher interest rates are affecting the housing market. Haven't been good lately, right? Mortgages for refinancing have been down like 60% over the last, from the year to last month. Origination loans to buy a new house or to buy a house were down 9%, to last month. So interest rates really starting to hit the demand for those mortgages and things for the housing market. And here we're going to see if it's really starting to hit, new home sales and existing home sales. So be watching for that. We do get some other, manufacturing and services data out this week, but it's all going to be about interest rates. It's all going to be about inflation and Ukraine. So probably market won't notice a whole lot on those economic points. Earnings continue to come out. They continue to beat expectations. And again, we're going to look at what the bank earnings have said about the consumer and the strength in the economy in a little bit here. But the bank earnings have been pretty well positive. I want to look at some of the stocks that are reporting earnings this week because I am watching a few of these. Bank of America actually reports its earnings before the bell Monday, so it's marginally up. Let's refresh this to see where this is. So actually, about 7 minutes. Bank of America marginally up in the pre-market, so probably good but not great earnings, nothing big. A lot of these earnings for the banks have been weak, only on a shift to greater loan loss reserves. This is something that we talked about last week. Again, basically, the banks, they see a recession coming. They see the potential for higher loan defaults coming into the into the 1 year, 2 year terms. So they're moving a lot of this money from their earnings onto their balance sheet as a cash reserve. Okay, that's called the loan loss provisions reserve on their balance sheet. They're moving money on into that what if account, right? So other than that, though, the earnings have been really good. That artificially reduces earnings. It's not something that they're paying out right now. It's just kind of a what if cash account that they're holding. So what happens is if the economy turns out to be stronger than expected and does not go into a recession or does not crash or those loan defaults don't creep up, then they can take that money from the loan defaults provision, bring it back into earnings and have surprisingly strong earnings. Okay. And that's something we've seen over the last year and why bank stocks did so well over the last year, but have since fallen, over the last few months because of this thing that they're doing. So watch that. More importantly, though, like we'll talk about with JP Morgan's earnings later, watch what the Watch what they're actually saying on the numbers, for the consumer. What is the consumer doing? What does that say about the economy? And how can you use that to invest? Prologis, ticker PLD, also is reporting earnings on Tuesday. It's an industrial REIT, right? A real estate investment trust. They own warehouses. They own industrial properties. One of my favorite real estate sectors right now, right? It has been over the last, probably over the last year, because of the rise in e-commerce, the rise in delivery stuff, all that stuff needs to be stored somewhere, right? And it's stored in these warehouses that are getting just great rates and a really high occupancy. Now, that said, this Prologis, the PLD, is getting a little too expensive, right? It's up 44% in the last year. Another industrial REIT stock that I like, Stag Industrial, that's ticker STAG, that's only up 11%, and a little bit better pricing on that one. So, I think you get one of two things. You get either shares of Stag come up because it's undervalued, or you start seeing maybe whatever was weighing on Stag start hitting Prologis as well, and Prologis comes down. So, I think the better play here is in Stag, but I would be looking for what they're saying in the earnings report on Prologis on Tuesday. Netflix is reporting Tuesday as well. Netflix stock down quite a bit, down 52% since October. So just a big crash in that stock. And, I'm going to go out on a limb here and say I think it could do well. And that is, before you hear me out, before you rush to buy any of the shares, because that is based on nothing. Really, that is the hype around all the streaming stocks has just disappeared, caused that 52% crash in the stock since October. And there really wasn't much exciting about Netflix in that first quarter. Okay, I don't remember, anybody talking really much about anything, and certainly nothing like Squid Games and all those other shows that we've gotten in the past that caused a lot of signups. So really nothing like that in the first quarter to get excited about the stock. But this stock is just perennially one that surprises when everyone has abandoned it. Okay, shares. Granted, shares still aren't as cheap as some of the competitors. It's trading at about 5.5 times sales compared to peers like, Disney, Warner Brothers, Paramount, all trading for well below that on a price to sales basis. It just seems that, Netflix is one that always surprises on earnings when everybody thinks that it's got nothing to surprise about. So I'd be watching for that. That's on Tuesday. Again, it's really a long shot call because it's really based on nothing. It's only based on the fact that Netflix always seems to be able to surprise the market when you least expect it. Tesla is going to report on Wednesday, and of course everyone knows Elon Musk loves to wow investors. But with, I'm kind of thinking with all the attention on Twitter lately, can he do it? I mean, what's he going to be able to say about Tesla that is going to surprise the market and drive these shares back up? The company recently announced a 2-day halt to its production in the Shanghai Gigafactory, due to the lockdown measures and COVID there. So I'm wondering if that's going to hurt those production targets that they have. The thing with Musk and the thing with their earnings reports and releases, he's not exactly the kind of person that likes to give bad news, right? So I think he's going to kind of dance around the bad news, give really good news, maybe exaggerate the good news sometimes. And this is nothing wrong. This isn't a dig on Tesla investors or anything, but Elon Musk, he doesn't hold with being that conservative prognosticator like a lot of corporate management is. So I think he's going to do everything in his ability, everything in his power to be able to give investors some good news and support those shares on Wednesday when they report earnings. Okay, AT&T is also reporting on Thursday. This is going to be the first quarter as a standalone company, right? They spun off their Time Warner segment last week. But the earnings results are still going to include those, right? The first quarter still included the Time Warner segment. I do expect management is going to talk about the future, right? As a pure play telecom carrier. There's really no major surprises expected, though, so it's not like the stock is probably primed to boom higher. I do own the shares. I still like the shares up to at least $30 a share, which would be that would be a 50% return plus this dividend. New dividend yield is about 4.6%. Actually, it's up to about 5.5% now. So, I mean, it's a solid dividend yield, and I think without the burden of a lot of these other types of businesses, I mean, for the longest time, AT&T was trying to be everything. It was trying to be direct TV. It was trying to be, entertainment with Time Warner and the content and the streaming and all that. And it was trying to be a telecom company. Okay. And telecom has become extremely expensive over the last year, trying to buy that 5G bandwidth for these companies. So I think, selling off those segments, getting that money to pay down their debt, and becoming, once again, just that pure play telecom carrier. I like the company. I think they've got a new focus. And we'll have to see how management is able to do that. But I think the shares are undervalued right here. I do want to look at, like I said, I do want to look at the bank earnings, what they've really been saying about, about the economy. Really look beyond what the rest of the market is watching. And if we, a great example of this was just J.P. Morgan's earnings last week. Again, bank earnings looked bad because they were moving that money from earnings into their what if account. It's a non-cash account. They don't have to pay this out as earnings, right? They're just putting it into a separate account just in case the recession comes, just in case loan defaults get bad. And that caused earnings to be artificially lower. So that's what a lot of the market saw was those lower earnings. What the market didn't see, what people weren't watching, is what these earnings, what this report actually said about about the strength in the consumer. Okay, revenue was down a little bit, down about 5%. So no big deal though. But they did report, let's find some of the things they reported here. Consumer spending on credit cards up 29%. Okay, so what we saw a lot of during the pandemic was people were flush with cash. People had those, had those stimulus checks coming in regularly. They didn't need credit cards, so they didn't need spending, right? They weren't going out, so they weren't spending anything. So now we are actually seeing consumers, getting back to spending, and actually spent 29% growth, on their credit card spending. A 64% increase in travel and entertainment. Okay, so if you're looking at some of those travel and entertainment stocks, those hotel leisure stocks, maybe even the casino stocks, that was a 64% increase last quarter in spending on travel and entertainment. I would really start looking at those sectors, especially some of the ones that are beaten down, some of the ones that nobody expects much from. They could get some surprise earnings boosts, when they report their own earnings. Okay, this is just kind of the power that you get from looking at these bank earnings that come out typically before most of these other companies report their own earnings. You can really see the strength in the consumer and what the consumer is doing. Okay, consumers started carrying more debt. Credit card loans. Credit card balances increased 15% over the first quarter versus last year. And of course, you could look at this one way and say, well, hey, people are taking out more loans. That's bad for the consumer, right? They're getting more in debt. Well, yeah, eventually, but not necessarily right now. What this tells me right now is that people are still optimistic. They're still spending, and they're once again spending beyond their means. Okay, like we said, what we saw during the pandemic, people were getting lots of cash. They weren't spending it because they couldn't go out. So they were really living under their means. They were saving up their money, and that was really holding back the economy. Well, now people are back to their old ways. Okay, they're spending beyond their means. They're increasing their credit card balances and really spending on those. Also seeing 15% increase in consumer and small business deposits, which is obviously very good, even despite all of this spending, all this consumer spending on credit cards, higher loan balances, things like that. People still have 15% more to deposit into their savings and checkings account. Okay, so that still tells me that people still are flush with cash, right? They still have lots of cash to deposit. So those higher credit card balances don't worry me about defaults or the economy or anything, because they've got this money setting aside. They're just spending more of it, right? They're spending some, they're saving some, and I think that is a very good sign for the economy. So now I do want to move it over into a question and answer here. I have seen quite a few questions and chats there in the chat. Love seeing everybody here. Ivan, good to see you. Melanie there, Kenny. Good to see you there. So I'm going to scroll through here, see what we have. 4 questions. If I don't see your question, make sure you use a question mark on it so I know it's a question, and I'll try to work through as many of these as possible. What do you think of? So Omari says, what do you think of Latin America and South Africa for the long term? Now, as far as investing, I'll assume, we can get into all kinds of other talks on investing. I started a lot of my investment career as an analyst in emerging markets, right? Analyzing emerging markets. I actually went to actually chaired a panel on Bloomberg on the emerging markets in Latin America back in September of 2011, right? It was, I think it was 2000. 2011. They were opening up markets in Colombia, Peru, and Chile. They were integrating those, and I was on a panel for that. Big proponent of EM investing, emerging markets, things like that. After about 10 years living in the emerging market, living in Colombia and seeing this, I'm becoming much more of an agnostic on emerging markets. Okay, the idea is that these countries are emerging, right? They're going to catch up economically because they're growing faster. The economies are growing faster. They've got much more room to catch up with those developing markets, right? And so the returns should be higher. The problem is, if you look at the actual history and what's actually happened, it just hasn't happened. These countries and these regions are perennially emerging. They're always emerging. And I think they always will be, okay? Because the problem, you get a problem with productivity. People don't have quite the same work culture in the U.S., in Europe, developed markets. People are working for that entrepreneurial spirit, and they're really working to work. They're working to work. They're at their work to own their job. Things like that. You just don't get that in a lot of these other emerging countries, right? Emerging markets. They have a much more work to play kind of culture, right? You do enough work, you do the work you need to do to be able to pay for what you want to do after work, right? It's much more work to live rather than live to work, which we have there in the developed markets. Not saying it's a bad thing. I tend to think that people in the developed markets, U.S., Europe, tend to work themselves to death, right? They work too much. They live to work, right? So it's not necessarily a healthy thing, not necessarily a good thing, but it does help with productivity, okay? It does help those economies grow, whereas in the emerging markets where they have that different culture, that different mindset, it doesn't help with productivity. Productivity is extremely low in the emerging markets. It always has been. And because of that culture and because of, widespread corruption and mistrust in organizations and in the government, it's never going to change. It's just a roadblock to development in those regions. So, I tend to avoid the emerging markets anyway, besides what we talked about earlier with the food price, with the food insecurity and that kind of thing. As far as getting exposure to those markets, I think you can get lots of exposure through international companies that do business in those countries and really benefit from the economic growth, but not necessarily domestic companies to those regions. But great question there. Hermes wants me to talk about conspiracy theories. I don't know any conspiracy theories. I'm not a big conspiracy kind of person. I tend to think things are black and white, and really what you see is what you get. So probably not the best one to ask about conspiracy theories and things like that. But that would be fun to be able to look into some of those. Lucas says fertilizer is the food for all foods. Well, yeah, but they've already gone up like 50 and 60%. Yeah, right. A lot of these fertilizer stocks have already gone up so much, and it is totally dependent on the situation in Ukraine, in Russia. Besides a lot of the food stuff, so wheat, barley, corn, exports. Russia is also a huge producer of fertilizers. So for as long as those sanctions and for as long as that invasion lasts, then fertilizer prices are going to be higher. But again, the opportunity there is that already passed. Those stocks are already way up. And if we get any kind of news or any kind of negotiated settlement or movement towards that, then those fertilizer prices are going to come down immediately. And, I just don't want, I want you to look the next step further out from that, okay? Because that's going to happen. Eventually that war is going to end. They're going to get some kind of negotiated settlement, and those prices are going to come down immediately, okay? So if you're in those stocks, it's really very much a timing thing, and a timing thing about something you have no idea. You cannot predict, when we're going to get some kind of negotiated settlement or movement towards that. So there's really no way to invest in that, okay? You have to invest further out what is going to be still a factor even after that happens. So I don't think it's the fertilizers here. I don't think it's the commodity prices on that. What do you think of pollution solutions? So Amari wants to know about pollution solutions. I don't know. Is that a stock or or a theme? But obviously, I think that's one of those longer term alt energy themes and green energy themes. I think those they're down right now, but I think now is a good time to start looking at those. Obviously, if the rest of the market has kind of abandoned those ideas of alternative energy, of green energy, green solutions, things like that, now is the time you start looking at those, because they are gaining momentum over time. Okay. Kenny wants to know if SoFi can find a support level. Yeah, SoFi has been tough, and I'll talk about a lot of the growth stocks, right? A lot of the growth stocks, SoFi, Teladoc, all those. It could still be tough over the next year, okay? And I'll even throw crypto in with this. Crypto is facing the Fed. All these growth stocks are facing the Fed, okay? And if the old saying used to be, or is, don't fight the Fed, right? That means, when the Fed is easing, when it's pushing money out in the economy, when it's lowering interest rates, asset prices, stocks are going to go up. And that's what we've seen over the past 2 years, right? Over the past couple of years, the Fed has increased its balance sheet, so pushed $5 trillion out in the economy. $5 trillion. That's about 25% of the entire economy of the U.S. over the last couple of years. They lowered interest rates to nothing. And all you have to do is look at a chart of Teladoc, of Zoom, of a lot of these growth stocks, of SoFi, of cryptocurrencies, right? Bitcoin, even after the sell-off, is up something like tenfold, 1,000% over the last few years. All you got to do is look at that to know that what was happening in that picture. Okay. It works on the other way around though too. It works when the Fed is tightening. They said they're going to take $100 billion out of the economy each month, to shrink that balance sheet. They're already raising rates. So it works on the other way around. So you are going to see some pain, I think, over the next even year, even 2 years, as the Fed tightens on these growth stocks, on the cryptocurrency. Now, why am I not selling though? Why do I own, we had our big 7 stocks video about couple of weeks ago, where I looked at 7 stocks I've got $250,000 in. They are, a lot of those are those growth stocks. SoFi was on that list. Teladoc was on that list. Those growth stocks that will do well over the next 10 years. I own about $400,000 in Bitcoin, Ethereum, Aave, Matic, Polygon Matic, and the Cardano ADA. So about $400,000 in cryptocurrency. Why am I not selling? If I do believe that the Fed is turning the tides, taking the punch bowl away, as they say, from this party. And it's because, one, nobody really knows, okay, especially with cryptocurrency. We could get a spot ETF approval from the SEC anytime. We could get it next year. We could get it next year. That could easily send Bitcoin up to 100,000, We've got more institutional investors coming into cryptocurrency. But for the growth stocks, these are still the same companies. These are still the same companies that investors were paying 30 times sales for last year. Okay, the stock price has come down, that valuation has come down, but they're still the same long-term growth story. Okay, SoFi, we've talked about SoFi quite a few times here on the channel. It is the bank of the future. Okay, it is one of the only fintech companies that has an actual banking license, that traditional banking license that allows it to do checking accounts, savings accounts, low interest loans, things like that. It's the only one of those fintech, those financial technology online companies that does that has that. Things like Teladoc, the virtual healthcare of the future, and they dominate that space. Okay, so what I want you to understand with these is, don't get scared out of them. Don't panic out of them. Okay, if you invested last year when prices were just ridiculously high, then I'm sorry, it sucks to be down, 50, 60, 70% in those stocks. You got to look at that's in the past though. You can't look at that loss and say, should I sell now? You got to look at the stock right now, the company right now, what it's valued at and what its future is. And I think the future is very good for those companies. The stocks are now very attractive values. I started buying in January and February in some of those stocks. Some of them I'm down in. I'm down in, I think I'm down about 20% in SoFi. In Teladoc, my cost basis in Teladoc is about $99 a share. It's down to $65, right? So I'm down, I'm down like 30, 35% in that as well. And I'm holding on because I think, the valuation on the stock is just too attractive, and it is still the same company that it was last year when people were paying 30 times on a price to sales basis. Okay. It's still the same growth company. 10 years from now, that stock is going to be 3, 4, 5 times more expensive. Okay. So yes, it sucks to see them go down. There could be more pain on the way, as interest rates continue to go higher. But I think you got to look at these long-term growth companies for what they are, very risky bets, but very long-term bets as well. Yoda Twinkie wants to know what's my IRA brokerage. I use E-Trade for most of my retirement accounts. I do have some other retirement accounts on. So Fundrise is a real estate equity crowdfunding site. I've got an IRA account there. I've got an IRA account on. I think I've got one on Ally Invest, a really old one that I don't really use that much anymore. But most of my the IRA ones and my SEP IRA, my 401k is on E-Trade, and that's just because I've had E-Trade since 1999, back when it was still Brown and Company. And I just, I set them up early then. So maybe not the best platform for an IRA. I would go with some of the no cost and the fractional shares. What's a really good platform for retirement investing is M1 Finance. Because what you can do, you can set up your portfolio with the exact percentages in each stock or each fund that you want. Then you just deposit money every month and it gets split up automatically in those. Okay, so it's a very easy investing. You set up an IRA there, you set up your portfolio, you just deposit every month. You don't even have to worry about it. So very easy retirement investing there. I would look at that. How about more agricultural tools? So Gabriel wants to know about agricultural tools, vehicles, machineries in that food insecurity theme. Things like John Deere, Claas, New Holland. I would look at those. I would think those would do well. I think even after commodity prices come down a little bit, I think that agricultural segment will still do well. Haven't looked at some of these in a while. So we can just kind of click through and look at these. Let's look at Deere as kind of a proxy for that industry, and I know they're up. Shares have got to be up year to date. It's just a matter of how far have they gone? Are they too expensive right now? And what do they do? When we get some kind of a moderation in those commodity prices. So before the invasion, I'd say. What was the invasion? It was February, in fact. So I'd say before the invasion, around 370. That means shares are up. Oops. So shares are up about 20% since the invasion, and since we really saw that big jump in commodity prices. Not as bad as a lot of the commodities or the fertilizer producers. So I wouldn't say shares have gotten too expensive on that basis. Just on the increase in the share prices, I would want to look at the something like the price to sales. Price to sales here for John Deere 3.1 times on a price to sales basis. That's not bad. For a non-growth stock. What I would want to do, I'd want to check the history of this, and this is just kind of a back of the envelope for what I look for when I'm just looking, just really looking briefly at a stock. What I want to see as far as valuation and as far as some of those other things. So what I would do, you can go to Morningstar, click on valuation, and it's going to show you a history of the price to sales, of the price to earnings. Things like that, those price multiples, where they've been in the past, to kind of get an idea of how expensive or how cheap that stock is. And we can see here that, let me see if I can increase this so you can see a little bit better. So Deere, it is trading at about 3.1 times on that price to sales basis right now. The 5-year average is 1.8 times. So it is quite a bit more expensive. 3.1 divided by 1.8, it is about 72% more expensive than it has been over the past year. You can see that, 2020 and 2021, it did trade for right around 2.4 times on a price to sales, so a little bit higher than in the past 5 years. So that's, it might deserve a little bit higher price multiple, and I'm thinking that's probably because of inflation, right? You see inflation come up, and these commodity prices do really well. And commodities, those food agricultural prices have done really well over the past couple of years as that inflation came up, and obviously that's good for John Deere, selling those agricultural tools and things like that. So probably a little bit higher valuation than that 1.8 times the 5-year average. These 1.4, 1.3. And 1.7 that you saw here, earlier, a few years ago. But I don't know that I would want to buy it at 3.1 times. I think I would like to see it closer to about 2.5, 2.7 times on a price to sale. So it does look a little bit expensive just on that basis. Now, again, I do think it is a smart theme. If you're looking at that food insecurity, if you're looking at higher agricultural prices for longer. So maybe you start a position now if you don't already have one. If you already have shares, you hold on to them. But I would like to see it come down a little bit better valuation than where it's trading now, just because it is so much higher than that long-term price to sales basis. Maybe look at some of these other stocks. You talk about Class, New Holland. Maybe look at some of those, see if there's a little bit better valuation in those, and maybe see which one is really the best performing in that industry. So Lucas says fertilizer is still cheap. I'm not sure about that. Potash prices, a lot of those have gone just crazy through the moon. So not sure that the fertilizer prices are necessarily cheap, or that they won't come down once we get some kind of resolution in Ukraine. So I'd be wary of jumping into fertilizers just right now. Yoda again wants to know, but what's the best REITs to invest in? What are the most real estate investment trusts? Real estate stocks. All you out there in the nation know I love real estate. Got my start in real estate as a commercial real estate analyst. Doing a lot of property analysis for the REITs and things like that. So real estate always has a special part in my heart, right? You really got to look at it by property though, by property sector. Okay, you can't just say all real estate is going to do well, because there are so many different factors on each property type. Okay. Residential has done really well as rents and as home prices go up. But, now we're starting to see the housing market crack a little bit, and we're starting to worry about that a little. Self-storage, those self-storage stocks have just boomed over the past couple of years. Those are getting very expensive in themselves as well. What I would be looking at for REITs, I would be looking at things like data centers. Data centers, good long-term trend, obviously doing well and should continue to do well, not too expensive. I would look at industrial stocks, like we talked about with Prologis, with Stag Industrial. I would look at those. I would look at healthcare stocks, especially. Healthcare REITs, right? You've got stocks like MPW, which I think is medical properties. They own the facilities, they own doctors' offices, hospitals, things like that. Those obviously very good long-term demographics supporting those, as well as good valuations on those. So I would definitely look for healthcare REITs, data center REITs. You've got your, what else did we say? Industrial REITs, and, maybe some of these hotel REITs, some of these hotel and leisure REITs, like we saw in that JP Morgan earnings release from last week. We saw 64% increase in the first quarter on entertainment and travel. Okay, so look at that. Before some of these hotels and entertainment properties, before they report their first quarter earnings, I think those could be surprisingly good. If the consumer is really spending that much on those. In fact, let's look at just get an idea of where some of those are. Let's look at some of those hotel stocks. So where's Marriott? What's that doing right now? Marriott International. let's see what they've done over the last year here. So up 163.20. So up what about about 8%, right? 183 divided by 163. Up about 12%. Up about 12% for the year, or for year to date. Been rising pretty well ever since October on Marriott. And we can check some of these other ones here. Let's look at Hyatt. I know casinos are another one to look at. Okay, so Hyatt, rising not quite as much as Marriott. Actually, pretty well flat for the year on Hyatt. And we can look at some of these others. You've got Wyndham, you've got Hilton, you've got some of the casino stocks, right? I think have done a little bit better. But I would really start looking at those, especially before they report their first quarter earnings here over the next couple of weeks. If we did see that huge bump in consumer spending for travel and for entertainment, for leisure, you could see some surprisingly good news in some of these stocks, in hotel, leisure, entertainment, things like that. So, maybe a little bit off the question there on that REIT question, but that's something I would start to look at. The real estate, the hotel and leisure real estate investment trusts as well. Andrew wants to know, when is the best time to put money in CDs? And I love this question, and I'll tell you why, because I really started looking at that Series I bond as something you're going to start hearing a lot about if you haven't already. A lot of talk about the Series I bond. It's a savings bond by the Treasury. And it's paying about 7.1% annual, right? Which is unheard of for a bond. Okay, we looked at the 10-year Treasury bond is paying 2.8%. Okay, so this savings bond is paying 7.1% now. It's going to reset in May 1st. Okay, this savings bond, the Series I, and I want to show you here. Just to give you a little idea, I'm actually putting a video together, but it's going to be a couple of weeks before that video comes out. So I want to give you the goods here. You go to treasurydirect.gov. Okay, if you go to Google, type in Treasury Direct, whatever. You go to treasurydirect.gov. Now, sorry, this is only for U.S. citizens. Only U.S. citizens, those with a social security number, things like that, can buy these. Sorry, everyone else kind of asked out. But if you're able to buy these Series I Treasury bonds, we can go to here. You go Series I, and you're going to get all kinds of questions. What is an I bond? What's the interest rate? All that kind of thing. Answer your questions here. But these things, these savings bonds, they reset twice a year, right? May 1st and November 1st, right? And each 6 months, the government, the Treasury, looks at these. They do a base rate, so like a core rate, interest rate on it, plus an inflation kicker, right? And so that's why these are paying so much interest right now, because inflation is going through the roof, right? So these are paying 7.1% right now. Word is May 1st, they're going to reset to 9.6%. So this is a guaranteed savings bond, a guaranteed return. You're going to get 9.6% on it, okay? A few things about this. Okay, you earn that yield, you earn that interest rate for 6 months. Then that rate resets, you earn that new rate for 6 months on these bonds. You hold them for as long as you want, up to 30 years. And you earn that interest every 6 months. Now, if inflation does start coming down, that rate's going to start coming down a little bit, but inflation ain't going to come, falling off a cliff, right? Inflation is still going to be high, and these are going to still provide that 7, 8, 9% interest rate, right? Now, a few things about this is since it is a savings bond, you have to hold it for a year, right? If you sell it within 5 years, so you have to hold it for a year. If you hold it for between 1 to 5 years, you lose 3 months of interest, which, if you hold it for 2 years, 3 months of interest really isn't much, right? 3 months of interest, probably going to knock off maybe about, maybe less than 2% of a yield off, 1 year. You're still going to get that same high interest for that first year, and then the year and a half. And if you sell it, you take off 3 months of interest. So it's really not that big of a deal losing on that penalty on interest. What I like about these is that, again, these are guaranteed investments, right? Guaranteed by the Treasury. So you're going to get your money back. You're going to get that interest rate. But they are a great place to, protect some of your portfolio from a potential stock market crash, right? So you can invest up to $10,000 a year into these Series I bonds. That's each person. So each person in your family can hold up to $10,000 in these Series I bonds. And look, worst case scenario is you got 10,000 locked up in a Series I bond. You're making, 9.6% come May. So you're making almost 10% on those come May. The worst case scenario is the stock market rebounds, another 15% or so. Stocks, they're not expensive like they were last year, but they're not cheap anymore either. And there are so many factors against stocks this year. A coming recession next year, possibly, things like that. Stocks aren't going to do that well this year. Stocks aren't going to do, 10, 15, 20% this year like they did last year. Okay, so worst case scenario, you're only going to be out maybe 5% by putting your money in this Series I bond instead of, in stocks. Okay, growth stocks could do a little bit better, but the stock market overall, I don't think you're going to be bad, in a bad situation. Best case scenario, you've got your money locked up in this Series I bond, you're making 10%, and the stock market crashes. If we see another 20, 30% downward movement in the stock market, you've got a big chunk of your portfolio safe here in these Series I bonds, making 10%, and right about the time that 1 year lockup expires, and you can sell those bonds or you can hold on to them for a little bit longer. But right about that time, then maybe the economy is starting to look marginally better, or right into that recession, and you can start buying those stocks at those lower prices. So we talk about the need for bonds as a part of your portfolio. That safety, bonds really aren't paying very much though right now. Okay, even some of those corporate bonds rates, 3%, 4% at the most. Here is a way to get almost 10% interest on your bond part of your portfolio, completely safe, guaranteed by the Treasury. So have that money, safe just in case the stock market gives you better prices sometime here in the near future. So a great question. Really look at those, those Series I bonds. This is the bear market, inflation. Okay, good buy right now since it's come down. Okay, Amanda wants to know, is NVIDIA a good buy right now since it's come down? Positive future growth as a company. This is something we've looked at. Actually, I think NVIDIA released earnings last week. We'd have to look at that. But NVIDIA, it's a tough one because it has come down so much. It's one of those growth stocks, but it is still so expensive. You look at NVIDIA, I think it's still trading at something like 13 times on a price to sales basis, right? Which again, if you've been watching the channel, my kind of upper limit for that price to sales ratio, even for growth stocks, even for stocks like NVIDIA that are growing sales like crazy, that have great futures, my kind of upper limit is that 10 times price to sales. Okay, it saved me from a lot of pain last year. A lot of those growth stocks trading for 20, 30, 40 times price to sales basis, and I wouldn't touch them because of that, because of that limit. And we've seen what happened. They've come down so much. They've crashed, 40, 50, 60%, right? And we have seen NVIDIA come down. Yes, it is coming. It is quite a bit down from its peak, but it's still so expensive, right? I think NVIDIA is really a call on the rest of the market, and a lot of these growth stocks are. So some of them are still very expensive. I think really what's going to determine what these growth stocks do, especially NVIDIA, over this next year is just purely the market, the stock market. If the stock market rebounds, if we get a rally, I think these do well. If the stock market continues to sell off, I think, these continue to get hurt. It's really not so much about the company itself right now, right? Because those bigger pictures, inflation, interest rates, the overall economy, I think that's really the deciding factor right now. What I'm thinking on these is, yes, I do think we get some kind of a relief rally here into the summer, into the fall. Stocks start coming back up a little bit. As we've seen in the past, stocks do tend to do well while the Fed is hiking rates, for a little while anyway. Those rate hikes, the interest rate is still extremely low, right? It's still not hurting the economy. So we are still getting economic growth. We still have good consumer spending. So I think the market starts to see that here pretty soon. I do think, inflation starts to come down marginally, just a little bit here in this next month and over the next couple of months. I think that's a good sign for the market. And I think the market does start to come up. So I do think these growth stocks like NVIDIA, like Teladoc, like, SoFi, some of those stocks, those growth stocks, I think they do very well here over the next 4, 5, 6 months, right? What I think you do need to worry about, though, is what comes after that. As interest rates do continue higher, start to actually cause some weakness in the economy. So into next year, 2023, even into 2024, I think the stock market starts looking extremely weak, right? So that's when you start, kind of pulling back. So in the here and now, right now, I think you can get in some of these growth stocks. NVIDIA is still very scary for me because it is so expensive. I think there's better deals out there. NVIDIA definitely has a great future, has an excellent future. It's the undisputed leader in these graphics processing units, right? And is going to be the driving force behind AI, self-driving, all these trends. It is just so expensive right now. And I think there's better deals in some of these other growth stocks that you're going to do just as well. I think you wait. You get into some of these growth stocks now that are good values, good attractive values. You wait on NVIDIA until the rest of the market comes down later on in the year, into next year. You wait for a better price, and then that's when you get in, when that point of max fear in the entire market in these growth stocks and that kind of thing. And I think you get a better price on shares of NVIDIA. But I do think they do well over the next couple of months as well. If you're careful, man, what happened to Beer Money Sundays? Steven wants to know what happened to Beer Money Sundays. Beer Money Sundays, and yeah, it's not necessarily not beer anymore. It's my Go Juice, right? My coffee. Beer Money Sundays turned into live stream Mondays, right? It was just easier to put together this Monday live stream, get you ready for the week, that kind of thing. Based on the newsletter that we got Sunday night coming out Sunday night. Sundays it was really tough to do those Sunday live streams, and still be able to get out with my family and enjoy the weekend. So kind of moved these into Mondays. I miss them too. I liked having a beer with you, and maybe we'll bring those back here in the near future and do that. Okay, what else here? Looking for more questions here. Is it reported 21 trillion? Dead, my guy. Trying to get more of the questions here. Saw something about rich dad, poor dad. Didn't see that, but Didi down 15% this morning. Yeah, Didi actually announced that it was going to put forward a shareholder vote about delisting. And the thing that was weird about that is Didi is planning on relisting there in Hong Kong. Had shut down that delisting, but they're still going to talk about delisting in the U.S. So shares are going to be kind of in limbo there. If they do delist from the U.S. exchanges, and then kind of a limbo between that point until they relist in Hong Kong. Not quite sure what management is thinking there. That's kind of a bonehead move to leave your shareholders in limbo. But that vote is scheduled for May 23rd. Going to be very uncertain for the stock at that time, and I'm going to have to reevaluate mine. I actually have the shares cost basis of around $2 a share, but I sold covered calls on that for about 70 cents. So my cost basis is right around $1.30 on that. So, I'll probably take profits in that just because of this move to delist the shares before relisting in Hong Kong. Not quite sure where that leaves investors if they delist before they actually have another alternative. Okay, Sammy wants to know about AT&T. Talked about AT&T earlier in the video, so go ahead and we'll just go back and watch the playback on that. Sonny wants to know any thoughts about Daily Journal selling off the Alibaba shares. That was weird, wasn't it? Charlie Munger, so the Warren Buffett's sidekick, right, and value investor, announced that he had bought a huge stake in Alibaba, and this wasn't more than 3 months ago, I think, right? Bought a huge stake in Alibaba, really a sign of confidence in the company and in Chinese stocks overall. They're in January or so through the Daily Journal, his company where I think he's the CEO or something of Daily Journal, or maybe the chair on the board. And then they just announced that they sold off half of that stock. So, something that kind of worries me here over the past couple of years with Berkshire Hathaway, with Warren Buffett and Charlie Munger here, they seem to be kind of getting away from their long-term buy and hold own the business kind of strategy, right? And I kind of wonder if maybe some of the other analysts, some of the other investors within those companies aren't guiding decisions a little bit more than these guys, these guys that typically have a different strategy, right? Because it used to be, Warren Buffett used to say, own the company, right? Don't own the stock, own the company. And he would buy companies and he'd hold those forever, right? And did very well. Obviously, Berkshire Hathaway, beat the market for so many years. But just over these last couple of years, I mean, it seems they'll buy stocks in a company, these companies, Daily Journal, Berkshire Hathaway, they'll buy a stock and then sell it within like a year and a half. They'll sell out at a loss, kind of panic and get out of the stock. So it's kind of weird that they would turn around so fast on those shares. Buy in January, sell within a quarter, really within a few months. So sell out of those stocks. So it seems they're much more trading on news rather than that long-term valuation, that fundamental value. I still own shares of Alibaba. I did buy them there in February and in March. Cost basis right around $83 a share. I think it's down. It's down a little bit over the last few days, but it's still up from that point. I still like Alibaba. Some of those other Chinese stocks still kind of worry me a little bit, but Alibaba, the valuation on that is just too good to pass up. Did a couple of videos on those, so look for those on the channel there. Manipulation. PayPal. What about Intel? A lot of these. It was Charlie Possible. Amanda wants to know about PayPal as well. Actually, also did a video on PayPal. I own the shares. It's one of my biggest holdings. I think PayPal is a lot like SoFi, is really kind of that fintech of the future. They've got a dominance, in those payments, in some of those other solutions. And what PayPal is doing, it's building a whole ecosystem around this. From budgeting, from bill pay, e-commerce and bill pay or payments, things like that. So PayPal is really, and the valuation is amazing on PayPal. Okay, the valuation on its Venmo app, that cash wallet app. People use the Venmo and PayPal as their wallet more than any other service, more than Apple Pay, more than Google Pay, more than any of these other wallets. They're using PayPal and Venmo, right? And those wallets are the finance of the future. That's where you're going to be holding your money. So I do like PayPal. I know it's come down, obviously, just like a lot of these other growth stocks. The problem is, folks, I mean, there's so many new investors just been spoiled over the last couple of years, to thinking that, you invest just because a stock is going up, and you stop investing when the stock starts going down, right? Or when it's going down. And that's the only reason why you invest is whether the stock's going up or whether the stock's going down. That's not investing. If you've been investing more than 2 years, more than 3 years, you invest in the company, you invest in their future. Okay. Just because the stock has come down 50, 60% over the last year, you got to look at the company, how it's positioning for the future and what the value is right now. Okay. I wouldn't buy shares last year. I wouldn't even touch some of these shares, the Teladocs, the SoFi, the PayPal. I wouldn't touch those shares last year because they were trading for 15, 20, 30 times on a price to sales basis, right? Even knowing what I know about the company and that I know the company is a great company in the future, wouldn't touch the shares, right? They had to come down 50 or 60% for me to look at them. Okay, now I'm saying they are good value targets. They are great, still the same companies with the same strong future. So you got to look at these companies. You can't just look at the stock price and say, well, shit, you're an idiot, man. The stock has come down 50%. Well, yeah, because it was just ungodly, ridiculously high levels last year. Okay, just because the stock is down doesn't mean it's a bad company, doesn't mean it doesn't have a future. Okay, you have to value a company based on its current valuation and what it's going to be in the future. Okay, great question there on on PayPal though. What about Netflix? Covered Netflix earlier. They're reporting earnings this week, and again, they always seem to surprise on the upside. I don't know how they do it. I don't know if they'll do it, but they always seem to do when nobody's watching the stock. They always seem to provide some kind of a surprise upside. We're about. We're about an hour and 15 minutes into this, so I'm going to cut it off here. If I didn't see your question, go ahead and ask it in the comments below, and I'll try to get to those later. Thank you for joining me. I love doing these Monday live streams. Get you ready for the week and really what I'm watching and what to watch in the week. So until then, I will see you next video.